Greetings. This is NDBC Kekwe. We have received many, many questions from our co-learners in Tekidia Mini MBA, essentially asking what happened, why are some of these banks having difficulties. Of course, we are scheduled to discuss investment portfolios, personal economy this weekend and also next weekend. Going to look at scenario mapping and how we can deepen our capacities to actually improve our finances and deepen abilities to actually weather some of these financial crises. So, but because the questions they just keep coming, I am forced to actually hopefully through this short video can explain to our members what really is taking place in the world of financial environment. So I'm going to speak today as a former banker and also someone who earned a PhD in banking and finance, and that makes it possible that I can actually go deeper into some of these constructs, and I'm hoping that I'll keep it really very simple to make it easier for every one of us to follow. So let's assume that there are 10 people today, and those 10 people, they have $100 each. And they now take the $100 to a bank, let's call it Tekidia Bank, and they deposit the $100 each of these 10 people they have basically. So you're going to have a total of $1,000 because 100 times 10 give you 1,000. And Tekidia Bank will say at no time will these 10 people come to ask for their respective $100. So typically what happens is that Tekidia will say, hey, I'm going to keep, let's say, $400 in cash or in any form electronically to make it possible for our customers to actually have money anytime they need it. But the 600 that remains, I'm going to invest the 600. And I can invest that money by lending it to another company to lend it to customers, or just so many other alternatives, buy bonds, and so many ways that investments can be done in a banking environment. So when one of those 10 people come to the bank, they can collect their money. But that does not necessarily mean that, as I said, all that 1,000 is actually somewhere in the bank. Provided that 10 of them are not coming at the same time, there will not be a problem because there is just enough money to take care of them and everything will be working very fine. But if there is going to be a scenario where all of them want to come at the same time, or maybe most of them, let's say 7 of them come at the same time, asking for their $100, all of a sudden, the cash requirement, when I say cash, can also be electronic withdrawal, will not be enough because that money, even though you see it on your dashboard when you log in into the app, when you log in into the web app or mobile app, that money technically is not actually with the bank. It's somewhere in a poultry business, it's somewhere in a construction company, it's somewhere in an oil and gas project because the bank has made loan using the excess of that money they have not actually kept in cash. Because of the trust that your money is there, nobody will be worried because that's the bank, that's the system. But something also happens. The decision the bank makes on that cash it is not keeping becomes very catalytic on what happens in that banking system. And so let's look at what has happened over the last few years. When during COVID, most governments around the world, using the United States for example, they reduced their interest rate. When they reduced their interest rate, essentially what happened was companies could borrow at a very ridiculously low rate. And because the cost of money was low, the incentive was basically go and borrow, go and borrow, and go and borrow, go and invest. And a lot of companies piled money, borrowed money, and they used that money to do whatever they wanted to do. And because companies were borrowing, banks had so much money because those companies were getting cash, were putting them in their bank accounts. And then after they have taken care of the total volume that will not be required immediately by customer, they now have to invest the rest. And one of the things most banks did was to buy bonds. Bond is basically what happens when a municipal, a state government, a federal government, or very, very great companies say, hey, I am going to pay you a certain amount of money on interest if you can give me money to go and build road, go and do construction, go and invest in new products. And that relationship is there, that if you give me this money, I'm going to take care of you. So during the time when the interest rate was very, very low, many entities, governments, they sold bonds. And those bonds were actually higher in terms of what they call yield. They were actually bringing better value, creating better gain for banks than the alternative investments that were actually available, that were less risky. So in other words, if you buy a bond from the United States government, you are really largely sure that provided that the United States government remains, is going to remain, that there's no risk. And they were also giving you better yield in terms of the money you are making than many other alternative safe investments that were available. So most banks bought those bonds from state governments, from local governments, what they call municipals, and things were happening fine. But unfortunately, as a result of free cash, free money, money everywhere, there was what they called inflation. The absolute value of money started struggling because everyone had money, coach. And because everyone had money, whatever you ask them, the prices people pay. You cannot also take out the fact that Ukraine and Russia got into problem. And as a result of that, Russia was sanctioned. And because Russia was sanctioned, so many economics, especially in the Western world, had to readjust. But that readjustment was actually on the point of scarcity. Because if some of the things that Russia was bringing to the world, some of the things Ukraine was bringing to the world in terms of supply, if those things were not available, it certainly means that a lot of demand was pursuing a smaller level of supply. And if that is the case, the implication is that price will go up. So the price of items, from food items to basic, everything you can think of, drugs, mug houses and things, everything was going up. But you remember the Federal Reserve, or what they call Federal Reserve in America, in Nigeria is called Central Bank. They really have two important roles they play. They want to keep the strength of their currency, and they also want to maintain employment. And they use tools to do those things by modulating the interest rate so that they can stimulate economic activity. And when you stimulate economic activity, essentially, you can grow up the total number of people that are employed in the economy. And if you also notice that, hey, a lot of people just fully employed, so look at the strength of your currency. So keeping the dollar strong and also making sure that Americans are at work, these are the two cardinal fundamental things that the Central Bank of the United States, what they call the Federal Reserve, what it does. So the inflation was very, very high. So he needed to make sure that the strength of the dollar does not go down. And that means that he has to fight that inflation. And by fighting that inflation, one tool is that he has to raise rates. When you raise interest rates, you're essentially making the cost of borrowing high. And when the cost of borrowing becomes high, it means not many people will borrow. And that was what happened. So over the last few quarters, the Fed has been raising rates. But there are also implications. Whenever you raise rates, those municipal bonds, those state bonds, unfortunately, interestingly, it has an inverse proportionality to this interest rate. Why is that so? When you borrowed at a very low rate to buy a bond, because the bond rate was a little bit higher, but when the government raises the rate, the implication that the cost of borrowing will be higher for people that want to invest. And if the cost of borrowing is very higher for those that want to invest, it means that not many people will be interested in buying bonds. And if you don't have many people buying bonds, at the end of the day, demand for bond will drop. And if the demand for bond will drop, Economics 101 says that price will drop. And that means the rates that you can actually get those bonds is going. And if that is the case, there is that tendency that if you have bought the bond, let's say at 3%, after the interest rate has been raised, it could be going for maybe 2.8%. And when that happens, it means that you have an unrealized losses, which means that even though you have not sold that bond, it means on your balance sheet, the price you pay for that bond, you are actually not going to even break even if you have to sell that particular bond at a particular time. And if that is what is going on in your case, you need to look for extra capital. And that extra capital means you need to show up your balance sheet because those losses are there. And if those losses are very huge for a small bank, it could be in trouble. And remember, companies, unfortunately, are not raising money easily. And because they are not raising money easily, there is also an issue. They now want to go back to their savings they have with the banks. And by going back to the savings they have with the banks are now required to now have more cash to take care of those 10 people who had put their money and who now need it because they cannot go and raise money in an alternative way for them to continue their entrepreneurial venture or anything they have wanted it to do. And if that is the case, because it causes a double whammy. You are struggling in the bond investments you have done. And those that you have also kept money for are asking for that money because the investment climate, they're not unable to raise capital. And if they're unable to raise capital, they are drawing down on the savings they have in the bank. That means the bank needs cash in order to take care of the customers. And that is what is happening. For us, Silicon Valley Bank couldn't just summon that. It failed. So we're going to look at this thing deeper on Saturday, and hopefully at the end of the day, we can have clarity on what we have to do to make sure that our personal economy, that we are actually in a very great position. Thank you for listening to Techidia Mini MBA Brief, DBC. Okay, good.